today, you're going to want to pull up a chair and make sure that I'd even say grab a pen and paper, because today we're flipping the script. So instead of talking about the frustrations of running your company, we want to talk about what happens when you decide that it's time to potentially sell your company. Our guests today are John Petroff and Peter Mistretta, who are partners with Knight Investment Group. Now, Knight Investment Group is an investment firm based here in the Pacific Northwest. And what makes them different and why we really wanted to have them on our show today is because they're not investors, they're partners. This is how Knight Investment Group works. They are committed to the long haul. It's a different approach than what you may think the typical approach is when someone comes in and purchases your company. Welcome back to another episode of the Frustrated CEO Podcast. My name is Patrick Lyons, and I am just one of your co-hosts here with my friend and my colleague, Patsy Feeman. Patsy, welcome. How are you?
I am quite well, and most curious for our two guests today.
John, Peter, first, thank you for being here. Great to see you both.
Thanks so much for having us. Great to see you too.
Now, as I said, you're not a typical private equity firm. On your website, you've described Knight IG as being in the trenches with your partners. So for a frustrated CEO listening today, let's just start with a simple, I'm assuming this is right in your wheelhouse. What are some of the bigger misconceptions that owners have about selling their company?
So there's probably a long list here. I think the most common ones that we come across are the amount of time it will take. So I think most sellers, or most business owners, when the time comes, they think, it's a matter of months or maybe a year away, but really it's a matter of months or a year away from really being prepared to even go begin to market your business. So that's probably one misconception. Two, I think, for most business owners who have never gone through M&A before, it can feel so daunting that it's not even worth approaching, right? So It's just so mysterious and seems so complicated. And while there is a lot of work and time that goes into making it work, anybody can manage through it, especially if they work with the right advisors or the right partner. So those are the first two that come to mind for me. Peter, what am I missing?
One thing to add to what John said, so the time it takes, a lot of people that we talk to, the most experience they have selling a really important asset to them is their house, which can transact in a matter of 45 to 60 days from the point at which you decide to sell the house to the point at which you're wired your money, and you can move on with your life. And typically, as John said, there's a period of time associated with preparing the business for a transaction, interviewing potential buyers for the business, and then ultimately facilitating a due diligence process and negotiating the specifics of the transaction. And that can be kind of, in our experience, the shortest time frame being somewhere between 60 and 90 days, all the way to 120 days to a full year to complete that transaction. I would say the other most common misconception is that everyone's dollar is as green as the next person's dollar when it comes to selling a business. And there are different types of buyers, and it's important to kind of think from the get-go what success looks like for an owner with family and friends and employees and other stakeholders in the business, because there are some people who will prioritize some things versus others when it comes to stewarding the business after you're no longer at the helm.
I'm going to use the house analogy. I kind of think about when someone is a very motivated seller, right? They're moving to a different country or a different part of the different part of even within the U.S., or it's an estate sale. Usually, the faster you need to sell it, the more you have to compromise on what you can get for it. Typically, is it the same in the business that if I want to get out fast, I should expect that I'm not going to get what I might otherwise get for it if I have more time to put the, to John, to use the phrase you said, like to prepare it for sale. Is there a correlation between how long I have and how much I might get for it?
All else equal, definitely.
Yeah.
There are obviously ways to
Yeah.
combat it with good advisors and engineering some competitive tension in a process like you might be able to do selling a house. But you'd almost certainly be able to do better under any set of circumstances if you have more time and you're not a motivated seller than if you are.
Yeah.
This is a corollary to that. I often hear that the seller, the business owner, thinks their business is worth slightly bit more than the market wants to pay. Do you run into that frequently as well?
Yeah, I'd say on average, most owners have a slightly inflated view of the price of their business. Not always. We've run into the opposite as well, but I think on average, and it makes sense. I mean, in most cases, we talk to owners who've owned and operated their business for decades and poured their, life's work into it, and so they should get rewarded for that. But often comparing sort of one asset to like a market average can be a little bit of a difficult conversation.
So I mentioned at the start that you're different, and that's why I brought you on. So let's dive into how your approach is different and why I'm hoping that can be somewhat of the context for today. So most of our listeners are familiar with what you might call the typical like buy and flip VC venture capital approach. It's almost like flipping a house. You buy it, you invest quickly, you're trying to enhance curb appeal, and then sell it for as much as you can possibly get. That's not your model. Your model at Night is more of a buy and hold model. So it's a fundamental difference that provides the context for the conversation today. So our audience is familiar with that. The idea of taking an investment with the understanding that there'll be an exit in 3 to 5 years. You're different. Explain the philosophy behind your model and how it contrasts with the buy and flip model.
Yeah. So, and even before that, another important distinction might be to point out that we're both local. Peter and I both live in Portland. I grew up in Portland in the Raleigh Hills neighborhood. My wife's family's, also from Southwest Portland. Like Portland's our long-term home, so we know we'll always have roots here. Peter is not from Portland, but he's married to a Portlander, so we'll give him a pass. And so that is one thing that just informs our personal view on how we invest capital. We want to be long-term stewards of the community and the business community here. The other, I guess, important distinction is how we've approached partnering with capital partners. So we are supported by other kind of equity capital providers who share this long-term approach, and that's primarily because they think in terms of kind of multi-generational wealth building. So for them, if they found a really attractive business that's compounding in value over time, it doesn't make sense to sell because they incur taxes, they incur deal fees, and they just want to go put the money into another investment that will compound in value over time. So it is just a more efficient way to build wealth over the long term. Peter, I'm sure you have more to add.
I'm going to beat a dead horse with the house analogy. So Patrick, you prompted the house flipper example where a buyer comes in, buys a home that he or she thinks has opportunity with some cosmetic upgrades to be resold in a short time frame at a much higher price than the cost to purchase plus the cost to make the cosmetic upgrades. And like that's just not a house I would want to live in. I wouldn't want to be the buyer of that house on the other side versus buying a house from someone who has invested because they're going to live in that house for the long term. So we just think better businesses are built when owners take this long-term perspective and the objective is building a wonderful business as opposed to turning around in 3 to 5 years and selling it for more than you bought it for after making some kind of, in business terms, cosmetic adjustments, but not anything that's really creating any value for stakeholders, whether it's employees or customers or suppliers. So we think better, just like foundational business building decisions and investing can be accomplished when you have this 10, 20, 30-year horizon. And we found it resonates very strongly with some of like kind of the family and founder owners that we are often working with, because that's the way that they've built their business over generations as well.
Yeah. Yeah. Just building on that point. I mean, just think about the approach you would take to running a business if you knew you had to sell it in 3 to 5 years. It'd be very, like using Peter's terms, cosmetic changes that may look better on paper, but don't necessarily lead to fundamental value creation and business growth.
Yeah, to me, the phrase that comes to mind is putting lipstick on a pig, right? You want to make it look really pretty so that you can sell it to somebody else and make your, get your ROI on, and it's a business model. It works, but Peter, you said something. Some of the clients, a lot of the clients that we work with at the Lions Group are family-run businesses, and in some cases, not even first generation, but second or third generation family business. And when they're thinking about their exits, they're thinking about they're feeling this sense of responsibility for all of the people in the building, that they don't want those folks to be thought of as headcount by a venture capital firm that's going to come in and, make the cuts to improve the bottom line so they can flip it. They want to make sure that their people are taken care of. And I think that's where, for a listener who's in that, who feels that sense of ownership and responsibility for the people that you've worked with, it is a family. It's a family business. There are family members in the business, but very often in family businesses, the whole thing feels like a family. And that's one, again, is why I appreciate the model, the buy and hold, where that the people are going to be taken care of.
Totally.
The term that comes to mind for me is legacy. We work with, it's aligning with people who have shared values, who want to create a legacy for the value of those in the business, but the product you're offering and for community the business operates in. That's not how everybody operates their business.
Or the fact that we're... Go ahead, John.
Go ahead, John.
Go ahead, Peter. Yeah, I think I mentioned earlier that for most owners we work with, it's their first M&A process, but that's also true for their employees. And so it's a scary time to know that, the person you've worked for decades potentially is selling and the business is in new hands. It's even scarier to think that, it's going to trade hands again in 3 to 5 years, right? So hopefully our approach also just provides a little bit more stability and legacy for the employees, which we also think adds value, right? Stability and a strong culture, it goes a long way.
Peter, what were you going to say?
I'm just going to say, and it's a good kind of building point from John's, the fact that we're focusing on partnering with businesses in the Pacific Northwest, with a particular prioritization on the Portland metro area, is we get to build like real personal relationships with the employees of the businesses that we're partnering with, in a way, maybe not, we're not trying to replicate the relationships that the current owners have with the employees that have been built over years, but hopefully we can build our own in a way that it's really hard to do when you're an institutional firm in San Francisco or New York or Chicago, and you're coming on site maybe once a quarter for board meetings or just to do kind of check the box site visits. Our intention and ideal setup is we're on site several times a week, really in the trenches with the team, building the business alongside them. If not in the business, kind of five days a week.
So you've mentioned a couple of times, John, you alluded to it earlier, the Portland feel, right? You feel a sense of community to the Pacific Northwest, to the Portland community. Peter, you just said as much. We have listeners and listeners in the podcast. We have viewers on YouTube who are outside of this area. Is this a model that the only Knight does, or are there? How do I, if I'm on the East Coast, how do I engage in a company that might share your values?
Here, I'd let you take this one.
Yeah, I would say there's an invite for a no strings attached conversation with us. We regularly spend time with like-minded firms across the country who are doing very similar things, potentially in whatever market your listeners are operating in. So there's a pretty good chance that we can direct you to someone who thinks about ownership and business building in the same way that we do. If for whatever reason, it's not addressable for us.
Yeah. We didn't invent this model, but it is, still a relatively small part of the investment world. But we can definitely help find the right people in the right geography.
I was struck when we first started this conversation. You were talking about the assets, and you differentiated the assets from the people. I talk to so many people that are interested in buying a company, and I say, well, there's actually a variety of components in this business, and I'll mention the people piece, and it just goes right by them like I just, didn't say a thing. And you've mentioned that, you've woven this through everything you've said so far, is that you look at the whole business. Why has that become important to you? What do you bring to the table that you two now say, no, it's a whole business. We want to look at the whole business.
Boy, I guess I'm a little surprised to hear that makes us unique. I think you're kind of missing the target if you're not considering the people in the business, the quality of the people and the culture. If
you're talking to the choir now,
yeah.
So we agree with you. But I can tell you, when I talk to other people in the community, they don't get this piece.
For us, it's pretty essential. In a less touchy-feely way, like just employee turnover in any business is expensive. And so to the extent you have happy employees who enjoy showing up to work and enjoy what they do and care about the success of the company and the investment's just going to perform better. I think it's just an essential ingredient. And if we're, considering two businesses side by side that do the same thing in the same industry with the same amount of sales, et cetera, and one has a terrible culture and one has great culture with great employee retention, it would lead to a tangible difference in how we would value those businesses.
And how do you assess whether one has a good culture, great culture, or not?
Yeah, there's only so much we can do from the outside in. There are some metrics like average retention, if there's some kind of employee satisfaction survey or something like that. But otherwise, just to be respectful of business owners and sensitivity around a sale, typically we're not in the business day to day and can't get a great sense for that. And so it's just something you kind of have to, it might be more of an art than a science, but still an important component in valuation.
Peter, you look like you were going to say something.
I would say typically we'll spend time with kind of some subset of the employees before completing a transaction, just to better understand this important component. But to John's point, we're typically not meeting with all the staff, especially under the guise of potential new owners until we've closed a transaction. But if there are key people that we're really going to be partnering with to take the business to where it is today to where we hope it'll be over a 10-year time frame, like those are people we'll spend time with to get a sense as to what their ambitions are, what their motivations are, what they like about the status quo, what they'd change if they were in the driver's seat, and as importantly, understand from them those same questions for the employees that we don't have the chance to meet with before completing the transaction, so that we can start to put the picture together before we're actually in there.
All those are great culture questions, right? What would you change? What do you like? Why do you stay here? So good for you.
So I mentioned at the top, primary topic today for our listeners is preparing your business for acquisition. As two guys, as two people in the business of valuing and purchasing businesses, what do you look for? Let's talk about some of the financials. Like, what do you look for from the numbers standpoint? And you've just touched on culture, but what are the non-numbers that you might look for that would make my business more attractive to someone who is looking to acquire?
I'll start with the numbers because those are kind of like the easy things. And in fact, they're the easy things to observe from the outside in as a potential buyer. There's also like some degree of control that if you're starting to think about this like early enough in advance of when you actually anticipate selling the business, like you do have some agency about trivializing moving the business in a different direction financially, but like you do have some degree of control over your financial performance based on decisions that you make if you're thinking about this 2 to 3 years in advance. So I'll start with the financials. I would say like the absolute most important thing to us is the stability of a business. That is like you could typically look at like two very simple headline metrics, like the trajectory of revenue over the past 3 to 5 years and the trajectory of operating cash flow over the past 3 to 5 years. So ideally, we're seeing like stable, low single digit growth in revenue and stable, slightly higher, low single digit growth in operating profit. But even if it's a stable business without a ton of growth, like that's still really wonderful. We don't need to see kind of like exponential growth for us to be interested. So stability is really important. It just is a testament to like the staying power of a business model and the staying power of a category or an end market. And then I would say the second most important thing is profit margin. And two important things come to mind on this. It'd be like gross profit margin. So what are you taking home after you've paid like your most basic cost to serve your product or service to your customer? And then what's your kind of net cash profit margin? And that's like kind of an evaluation of how you're managing the operating expenses of your business after you're kind of taking home your gross profit margin. So if you have a really high gross profit margin, it's an indication that like your customers really, really value your product or service, and it's probably differentiated in some way. And that like defensibility is something we get very excited about as buyers. And then the kind of net profit margin is, like I said, an indication of like how well the business is being run. Like if you've got a really high gross profit margin, you're endowed with like something pretty special from a business model standpoint. And then below that is kind of an assessment of like how well you're managing what you're endowed with from a gross margin standpoint.
Perfect. How about the non-metrics, the non-number metrics? Again, you mentioned culture. What else? What else makes a business more attractive than others?
For the size of business we look at, a typical risk is what we would call key man or key owner risk, where the owner, essentially makes the business run. And if we were to, if that owner were to sell tomorrow and retire, the business would, fall apart. So it's one thing to be involved, that's totally fine and expected, but it's a different conversation if the owner owns every key customer account and the key customers only buy from the owner because they're close pals, or it's a really technical business and there are no technicians in the business because the owner, has all of the technical information and systems and processes just documented in his or her head, right? Like that's a non-quantitative risk that we often come across.
I'll give you like a very relevant example of this, John and I had breakfast one morning with the owner of like a residential trades business, and the owner of this business was the founder, and he grew up as a tradesman himself, and so he was like probably the best tradesperson at the business. And over the course of an hour and a half breakfast, he probably got 10 phone calls from his techs in the field asking about like advice on how to accomplish something or other, or how to price something. And that's a great example of what John's describing, where like this guy was like so valuable to the sustainability of this business's operation, where like it would be really hard to extract him from the business and maintain the success that he's accomplished in the past. So to the extent that you can build systems and processes around what you're doing really well in a way that like elevates you out of doing some of like the really day-to-day tactical stuff. I think that's, sorry to steal your thunder, John, that's probably where you were headed, but super valuable.
And yeah, and that is a situation that over time, with a lot of work and effort, we could solve for. But again, if we're looking at two businesses side by side, and that's the owner of one business, and the other business, has installed systems and processes that allows the owner to lift himself out of the business a little bit, like we can just get more comfortable and therefore pay a higher value for the second business.
It's a great sign if over a month of conversation with a business owner, he or she spends half of that time in Cabo or Hawaii, because that means they've been able to extract themselves out of the business in a way that like would facilitate a smooth transition in ownership.
And I can imagine what it would have been like sitting at that meeting with the owner after the third call he answered during your meeting to sell his business. You're probably like, okay, we're done. We need to get out of here.
But here's the irony. It's like the number of owners that we meet, or owner could be CEO, it could be founder, the number who wish that they could extract themselves from the business. And yet they just don't. So it's not like they're fighting you on this concept. They're just not able to do it. That's the challenge. Patsy, I can see you got wheels spinning.
Oh, yeah. I mean, we work with a lot of CEOs and seniors. Is the owner working in the business or on the business? That's what you're describing. The person in Cabo is probably working on the business. And some people go, oh, I didn't know there was any place for me to stand then to answer all those tech calls during a lunch meet. Oh, then I'm open to it. But I'm sure Patrick and I have a couple of prospective clients that come to mind that just can't step out of the day-to-day, no matter how much time you spend with them, John.
And sometimes I think it's not the systems and processes, it's ego.
Yeah, or just comfort. For a lot of people, it just is a scary proposition to think. They just can't get comfortable with like, what will the business do if I'm not? And maybe that's ego, but it's also just potentially, I think, kind of scary for some people.
Well, I'm particularly empathetic to it because most of these entrepreneurs and owners didn't get to the level of success they're at when we meet them by taking their hands off the wheel. So like, it's a really hard transition to make, where it's like, okay, I've reached the mountaintop and now I'm just kind of like slide down. That's not like that's not how they got there. And so why would they change what's working? But it is it's an important transition to make. And it'll be valuable, to start thinking about it probably sooner than once you've decided to sell imminently.
Well, and I compliment you both for recognizing that. It's when an owner is set up like you just described, then the whole business is aligned with that, right? The only person that can answer my technical call is the owner who happens to be at a meeting to potentially sell the business. I mean, that's like crazy. And it happens every day.
Yeah. It's, it's not dissimilar from what there's kind of
Absolutely.
expressions around like physicians and lawyers, about being great at their practice.
It's the human condition.
Managing their firms.
I'm curious now. The goal of the show is to address the issues keeping CEOs awake at night. The frustrations, right? It's frustrated CEO. It's in the name. Are there frustrations that actually are the frustrations at the CEO level or the senior team or even at the business level that actually make a business more attractive to you? I'm thinking like, a client that doesn't have maybe it doesn't have the latest technology, right? That knows that if only we could make that investment, that would significantly streamline our communication. It would improve workflow, make us more productive, right? Help us squeeze the middle of the P&L and flow down to the bottom line. Is that something where you're like, oh, that's an easy fix as an outsider coming in? We can, when we purchase the business, we can make an injection into the technology. Like, that's for example.
Sure. Yeah. I'd say there's a little bit of tension between, those kinds of things where we look from the outside in and say, well, it's hard to put much value on that business because they lack these basic systems and processes. On the other hand, like, we like those opportunities potentially because that's what we would consider low hanging fruit, right? So, like, we're happy to pay up for them when they're there, but to some extent, we like opportunities where we know we can go add value.
Yeah, I mean, like, again, frustrations, maybe with sales channel or the marketing just isn't there, and you're seeing that as it's a fantastic product that nobody knows about, or more people need to know about. And if we could fix that, and not just if, we fix that, and therefore that makes this business more attractive because we can realize the ROI just by continuing to do what you're doing, but real business change as opposed to some of the short-sighted ones if you were looking to flip.
I'll try to contextualize it this way. I would say every business that we spend a lot of time either considering or ultimately partnering with has opportunity for improvement, either growth in revenue, which will translate into growth in profit, or just kind of growth in profit by doing what's already working well on the top line. We never trivialize what it takes to like accomplish those improvements. And typically, so like change is hard. Every one of your listeners is going to appreciate that. And typically, like if it's like such a no-brainer improvement or investment to make, but the owner hasn't made it, there's probably a reason why it's like not as easy to actually like achieve that opportunity or accomplish that opportunity as like we were thinking about it from the outside in. So I would say, like, generally speaking, we always try to find the opportunity for any business or the opportunities for any business we're evaluating. And we're trying to kind of like figure out how much it's going to cost to take advantage of that, capitalize on that opportunity, and how likely it is to capitalize on that opportunity. But generally speaking, like, we don't get more excited about an opportunity, like a business that hasn't made important investments that we think are necessary. We would actually probably give a business owner more credit for making those investments and like validating that the opportunity we see is out there, even if they haven't like achieved the full opportunity yet.
That's where I was going as I was thinking more about it. Real life examples. When I'm within a year or two of hanging it up, right? I'm ready to walk away. I'm more senior in my career. I don't necessarily even, I've learned the technology we have, but the thought of a whole technology upgrade is A, it's costly. Why would I do that when I'm looking to get out? And B, technology is scary. Why would I do that when I'm looking to get out? What's the motivation for do it now, even though it's scary, because it will make my business more attractive to a potential buyer? If I sell it without making that upgrade, am I selling it at a discount?
I think the answer, I'm going to give you an answer you and your listeners probably aren't going to be thrilled with. The answer is like, it's contextual. It depends on like how foundational the investment is, how expensive the investment is, and like what is the set of opportunities that is unlocked by making this investment. So if it's something as simple as like you have been doing bookkeeping on a pen and paper kind of spreadsheet, and you're deciding whether to upgrade to QuickBooks Online, like that's kind of a foundational investment that is considered table stakes for buyers like us, and for businesses like what we're looking for. If you're talking about going from QuickBooks Online to NetSuite, which is kind of like a Cadillac ERP system that will support growth for kind of like the next 10 years of what you anticipate accomplishing, like that's probably something you might consider holding back on, because that's like a substantial investment that you don't really need to make. It's going to be it's going to take a really long time for like the returns on that investment to materialize, and you're probably not going to get credit for those for the returns on that investment because of how long it's going to take. So I would just say like it's hard to give a blanket answer, but generally speaking, like if it's very clear the set of opportunities that an investment's going to unlock, go for it. Particularly if you're going to be able to demonstrate in short order progress on achieving some of those opportunities. And also if you're kind of like behind on making an investment, I would also say like go ahead and make that investment if it's going to be expected that you've made that investment based on where your business is and based on what you hope to accomplish in a transaction.
That was a very helpful distinction, looking to the next 3 years, 5 years, 10 years. So I think anybody listening would go, oh, I can understand, what I would base my decisions on.
Excellent. All right, Patsy, as we near the end of the episode, what questions do you have for John and Peter that we haven't gotten to yet?
I have any specifics for now. I'm afraid if I started asking more questions, we'd be into the second episode of this podcast, which may be in our future, but isn't today. So I'm going to thank you for your wisdom and your heart.
Oh, we may need to, yeah, for sure. There's more to cover. So really my last question, and I think it's more, rather than ask it in the context of the conversation, we end every episode with, let's get practical, right? Our listeners have come to know this by now. This is the part of the conversation where we like to ask, what can our listener do today to begin making progress in the business so that, on the topic of today, so they can make their business more attractive for acquisition or sale. So my last question was, what are like 3 things that a CEO should be doing? That, what should they be focused on to make their business more attractive? But maybe that's really it's a good lead into let's get practical. I'll ask John and Peter. You get to go first so that we don't take the good ones. But what advice would you have for a founder, a CEO, a senior leader? What should they be doing today to make inroads in the areas that we've talked about today, to make their business more attractive 3 to 5 years from now?
Yeah, I don't know that this one actually makes the business more attractive, but I think just a fundamental first step when approaching the exit conversation, just make sure you have like a very clean set of financials, that you could explain to someone who's never looked at your business before. All the time we talk to business owners who have kind of a rough sense of revenue and earnings. And then we go actually look at essentially like the tax returns, and they don't necessarily, it's hard to connect the dots between what the owner has in their mind and what the paper says. So I think just like getting crystal clear on how your business has actually performed, and if there have been changes in performance, what has driven those changes. Again, it doesn't necessarily change the value of the business, but that just is the first step to even entertain the transaction conversation. And along those lines, again, dodging your question, but this doesn't really necessarily add value. I'm letting Peter come up with some better answers while I ramble. In my notepad. I'd say go reach out to someone like us. Like Peter said, we're happy to talk to anyone with no strings attached, or go call up at least a few business brokers so that you can hear from them, like how will the world from the outside in look at your business? What is the process to go through the transaction? Like what should you expect? How long will it take? How much work will it take? If I were a small business owner considering exit, those are the first two things I would do.
Excellent. Peter, what would you add?
I had three, two of which were strongly overlapping with John's. So I'll just add the additional commentary. So on like getting your finance and accounting house in order, I actually do think that is value accretive to an owner. So like not only is it just going to be like helpful for the process, and it's like the foundational set of data that a buyer is going to start with to determine whether it's an interesting opportunity for them. It's also like a really strong signal if you have clean, reliable, and accessible financial data that you've like invested in infrastructure elsewhere in the business that's going to allow it to run smoothly after a transition. It's not great if it takes an owner 2 weeks or 3 weeks to cobble together, loose sheets of paper from a file cabinet to put together historical P&Ls, because that means it's probably going to be really hard to figure out how to, like, when that owner's gone, how to figure out how to, price a certain product or service, or do whatever else that's necessary to run the business. The second thing, which John didn't mention, I'll get back to the third thing, which he did, is I would encourage owners who are considering selling to do some really deep soul searching by themselves and with their family to determine like what a successful sale looks like. That will almost certainly include like what is an amount of money that would be worth selling the business for. It almost certainly includes what the profile of the buyer is that would make the owner happy, and it probably also includes some like squishier stuff around like how is the new owner going to like run the business after the transition and treat your employees and take care of your customers, many of whom the business owner probably has personal relationships with. And then the third thing, after you've done your soul searching to determine what a successful transaction looks like, it's completely not in our interest to advise this, but I would encourage you to hire an advisor. This is going to be a super emotional and intense process. There's no way around it. That like doesn't matter how you cut it. The most frictionless and seamless sale processes are emotional and intense. And it's super valuable to have someone in your corner who is going to be purely rational and help you kind of navigate the emotional aspects of it, and who's also seen a sale process before to help you understand like what is customary and what's unusual, what's fair, what's unfair. And so I say it's not in our best interest because typically, we're not getting a good deal buying a company that's being sold by a very sophisticated and kind of in the know advisor. But it's the best thing to do if you're a small business owner.
Awesome. We'll circle back and ask if there's anything we forgot at the end. Patsy, what would you add?
To add, and John, you kind of went by this quickly, that running a business, selling a business is an art and a science. There's the facts and there's the emotions. There's the numbers and the non-numbers.
Yeah, I wish it was more black and white. But when we're looking at something, there are some external metrics we can compare businesses to. There are obviously intrinsic metrics associated with the business we look at, but often like how we feel about a business and how we value it comes down to a bit of a judgment call.
Mm-hmm. All right, I have a few that I'll add. We led with this. John, I think you made the point. Selling a business takes time, probably longer than you think it does. And you're likely some time away from even being ready to sell. So I think the let's get practical is start now. Don't wait. That if you wait, you'll likely be selling at a discount because you're too motivated to get out faster. Peter, you talked about this. Oh, you both did, but the owner's involvement in the business directly impacts the valuation of said business, right? So build the systems and processes that extricate yourself from the day-to-day, from the tactical, so that you can run your business from Cabo or from Hawaii, which again, every listener is going to go, I want that. Okay, so do it. Because not only will that help you today, but that's going to help you in the long run get more valuation for your business. I love some of the metrics that we talked about. The stability of the business, the metrics that drive that. Pay attention to that as an owner. Talked about the trajectory of revenue, the trajectory of cash flow, profit margin over this like 3 to 5 year horizon. These are things that you can be paying attention to today. You can be making intentional decisions to influence them today, and that will help you when you ultimately sell your business tomorrow. And then the last thing, because it is near and dear to our hearts, is just as there are financial metrics, there are numbers that impact the attractiveness of a business. Culture matters as well. That what I heard you say is if you've got two businesses that are essentially equal financially, you're going to take the one that has a better culture. And so that really does matter. It's not culture for the sake of culture. It's culture for the sake of better valuation of your business.
I would say there's also probably some subset of your listeners who want to take some chips off the table or sell their business, but still have energy to build it into the future. And those two priorities are not in conflict. There are opportunities or options for you. That's kind of a profile of opportunity that we're very comfortable with, kind of backing an existing ownership group or management team to take some chips off the table, but continue running the business with our partnership. So, and I would just kind of crystallize some of the things that you said with, the better the business, the higher the price a buyer is going to be willing to pay. And the better the business is, the stronger the profit margin, the stronger the team, the stronger the scalability of systems and processes and technology. So, these things are important not because like you can gimmick them. They're important because they've been like intentionally invested in and built. So I would say, just continue to kind of invest and run the business as if you're going to own it for the long term. And over time, that's going to materialize in a higher valuation.
Sounds good. John, Petroff, Peter, Mistretta, thank you so much for joining us. Listener, thank you for sticking with us to the end of another episode of the Frustrated CEO podcast. I do know this as well. Peter and John, just like Patsy and I, are very active on LinkedIn. So connect with us. Connect with us on LinkedIn. Connect with Patsy and I for content, anything on the show or the work that we do to help businesses scale and grow. And connect with Peter and John to stay informed on the latest, preparing your business for acquisition and sale. I think that's all I got. Check us out. If you're listening, make sure you check us out on YouTube. You can find us. You can see all of their sweet faces and my not suitable for TV face. Right? Better for Peter. Peter and I are tired. Peter and I have faces for radio. So, but check us out on YouTube. Like, follow, subscribe. You can find us on LinkedIn. You can find us on Instagram, on TikTok. We are everywhere. So make sure that you're connecting with us there. Let us know your thoughts. And again, we'll see you next time on the Frustrated CEO podcast.